Hello, welcome to the second of the two audio recordings on the lecture on monetary policies. So in the first recording, we discussed how banks work and why they are so important for the economy. So then the next question becomes, what kind of mechanisms do we have in place to make sure that banks do not go bankrupt? Because as we discussed before, when they do go bankrupt, it actually becomes very disastrous for the entire economy because the lending system stops and it impacts all other businesses in the economy. There are three mechanisms that help out banks to make sure they don't go bankrupt. This is not to say that they do not go bankrupt. It's just to say that these mechanisms help them out in various ways. First one of these is FDIC insurance. Secondly, federal funds market. Thirdly, Federal Reserve, also known as Fed. FDIC stands for Federal Deposit Insurance Corporation, and it is basically a pool of funds that are created by the federal government. Or actually, the law is created by the federal government, and the federal government requires banks to pay premiums to this pool for the amount of deposits that they receive from savers. So this pool of money keeps growing and growing, and it's only used, that money is only used to compensate account holders in banks when their banks go bankrupt. So let's say you have an account with some bank XYZ. You have a certain amount of money in that bank account, and the bank goes bankrupt. You get compensated for your money, so you don't lose your money. Currently, the limits to that is up to $250,000 per account type, per bank, per person. So if you have one savings account in a bank and an IRA account, which is a retirement account, with the same bank or some other bank, then the limits are $250 for each of those accounts. And the way that the FDIC insurance helps out banks is that it simply eliminates, well, maybe not eliminates, but mitigates the risk of bank runs, which is bank account holders freaking out basically when their bank is in trouble and they're literally running to the bank to physically withdraw all the money they have in that bank account. In the times before FDIC insurance was adopted, bank runs were all too real. They happened so many times before. They were one of the reasons why we ended up with the Great Depression in 1929, which took about a decade to get over it. The second mechanism is what's called federal funds market. And this is another federal government program that's created and regulated by the federal government. And it's a digital market in which banks borrow from one another. So again, let's go by the same example. You have an account with bank XYZ and your bank is in trouble. Their profits are way down and they look like they're going to go bankrupt. They're going to be insolvent. What the bank does is, economically speaking, your bank has a liquidity need, meaning they need cash to continue to operate. So what they do is they go to this digital market called federal funds market, and they ask other banks for loans to themselves, right? And so this market is created by the federal government and regulated by the federal government, and it's the second mechanism that helps out banks when they need liquidity. And the third mechanism is Federal Reserve, shortened as Fed. And we will discuss Fed in more detail in this part of the lecture, since they are the ones that are adopting monetary policies in the United States. Fed is the central bank in the United States. It is a government-run bank whose primary mission is to act as the lender of last resort. This means that when banks are in dire conditions and they need liquidity or cash or money badly, but they can't find it from the federal funds market, meaning from other banks, then they can knock on Fed's door and Fed can issue the money they need in the form of a loan. They are not legally required to issue loans for every bank asking for money, but they typically do in practice. When we say Fed, we're not actually talking about one single organization. It consists of 12 regional banks. The United States is divided into 12 regions, and there's one Fed for each of these regions, adopting policies that impact that region only. There's one in Boston adopting monetary policies for the New England area. There's one in New York adopting policies for New York and Connecticut and some nearby areas. There's one in Philadelphia, one in Cleveland, one in Richmond for the East Coast, Atlanta for the Southeast. There's a Fed in Dallas adopting policies for Texas and nearby areas, one in Kansas City, one in St. Louis, Chicago, Minneapolis, and lastly, San Francisco for the West Coast. So when we say Fed, we are actually talking about the governors and the team of executives who consists of the governors from all these 12 regional Feds, and it's located in New York, and it adopts monetary policy for the entire United States. So regional Feds adopt policies for their regions only, and they collectively also adopt policies for the entire United States. And Federal Reserve is created in 1913 as a result of a number of banks going bankrupt due to bank runs. There are three jobs Fed is charged with. First is acting as the lender of last resort for banks. Secondly, they create and conduct monetary policy. And thirdly, they supervise banks. Federal Reserve supervisory function has been long criticized because Fed has a very unique structure. In all other countries, central banks are both owned and controlled by the government. But in the United States, Federal Reserve is controlled by the government, so it's the political leadership that appoints the governors who run this organization, but the Fed is owned by a number of private banks. So it has a unique structure that is privately owned but publicly controlled. So some observers argued that this structure creates a conflict of interest because it's not realistic to expect an organization to be owned by banks yet be charged with supervising the very same banks that own them. So as a result, we see that banking has been predictably one of the least regulated and least supervised sectors in the U.S. economy, which creates problems for the whole economy every several years in the form of some recession, unfortunately. So finally, we can discuss monetary policies. As we discussed before, it's Federal Reserve's job to create monetary policies, and it's one of the two types of policies. Monetary policies seek to change the amount of money circulating in the economy, whereas fiscal policies seek to create money for the economy, so the economy would get out of the recession itself. There are three main instruments of monetary policy: changing the reserve requirement, changing the interest rates, and buying or selling government debt. Changing the reserve requirement is what we discussed in the first of these audio presentations. So if the economy is growing too slowly, or if it's in a recessionary state of some sort, then you would expect Federal Reserve to lower the reserve requirement, because this would mean that if they change it from let's say 10%, which is current level, from 10% to, let's say, 7%, then less of the money that banks receive in deposits would be kept in reserves, and more money would be created in loans, which would stimulate economic growth. These types of policies are called expansionary fiscal policies. Expansionary monetary policies, actually, because they seek to expand the growth of, expand the GDP in the economy. Second major instrument Fed uses is changing the interest rates. So when there's a recession, you would expect Federal Reserve to lower the interest rates so that cost of borrowing would go down and more individuals and businesses borrow money, which they turn around and spend to various purposes like investments or creating new factories or starting new jobs, new branches, new stores, spending new money as consumers, etc. So, which stimulates the economy, and the economy gets out of the recession. Now, you might ask that in a democratic environment, how can government change interest rates, which should be the business of private banks? Shouldn't, in other words, Citibank be setting its own interest rates? How can Federal Reserve dictate a change in the interest rate? And this would be a very good question. The answer is that Federal Reserve or the federal government only changes the interest rates that it charges banks when banks borrow from the federal government. But it has an impact on the banking sector because when they lower the interest rate they charge banks, then this would mean that whichever banks borrow from the Federal Reserve would find cheap money, and they turn around and issue loans with a smaller interest rate to other economic actors. So this gives them a competitive advantage. So all other banks that compete with this bank have to follow the suit, and they have to borrow money from the Fed, and they have to also lower their own interest rate as well. So as a result, in practice, we see that Fed or federal government reducing its interest rate functions as the entire banking sector reducing its own interest rate as well. When we look at the U.S. history in the last 45 years or so, we see that every time the problem in the economy is high inflation, then the Federal Reserve leadership adopted contractionary monetary policy and they increased the interest rates. And when the problem is high unemployment, they did the opposite and they did expansionary monetary policy and they lowered the interest rates. This is very much consistent with the theoretical expectation. Interest rates can technically be even zero, actually even less than zero. There is such a thing as negative interest rates. Here I'm putting a video and you can check it out in the link below in the description section of this video. Please check it out on your own time since for time limitations I can't show it in this slideshow. It is quite an interesting phenomenon, negative interest rates, which means that you take out a loan and you pay back less than what you take out. So it's the banking sector creating incentives for people to take out loans. Our current situation in some ways warrants this type of behavior. So please check it out and get a sense of the way that interest rates work in the economy. Buying and selling government debt is the last one of the instruments, monetary policy instruments. So when the economy is in trouble, there's a recession, then the U.S. government buys debt obligations, which means treasury bills, notes, and bonds back from the economy, and more money enters the economy as a result, expanding economic output. During the Great Recession in 2007, we see that the U.S. government employed quantitative easing, which is another way of saying they bought long-term government debt and mortgage-backed securities from banks so that banks would have some relief and start lending again.